Stephanie, your take on this volatility that we're seeing and what Jay Powell may say and its impact on markets?
Well, volatility naturally attends turns in the credit cycle. I mean, volatility and liquidity move hand in hand. So if you're going to take marginal credit away, you leave the markets duking it out with the economy for that marginal liquidity dollar, as that tide recedes. So that's not surprising at all, given, what we're seeing on the credit side. As for Powell, I think the reaction to his initial testimony was perhaps a little too extreme because, if there are no atheists in foxholes, the one thing we know for sure is there are no hawkish central banks in a down stock market. I mean, he can sound really hawkish today, but, give it 10% and they'll hit the mics and it'll be a much more dovish tone.
Not only that, but it's nothing really that we didn't know, right? When we look at his testimony on Tuesday, okay, so maybe he suggested 4 interest rate hikes. He didn't actually say that, though, by the way.
Right.
I mean, that's what the market thought.
That's a good point.
He never actually said that. But he just said that the economy's doing better and that, inflation is going to become an issue at some point.
He can't be perceived as a pansy as his first act as central bank chairman. He's following Janet Yellen, who instituted this. If he, as his first move, blinks, he really sets himself up, his reputation up.
He kind of talks like a normal guy. I mean, not that a PhD economist is not a normal person, but, sitting through some of the Greenspan testimonies years ago, or even Bernanke, even Yellen, it seems, just generally speaking, like a more... maybe it's just a natural way of saying if he thinks things are good, he's going to say it. And he's fairly optimistic. And then people just read, to your point, Stephanie, they're just going to overread into that to say, well, of course, they're going to raise rates 4 times. And maybe, of course, that's not the case if the data doesn't work out that way. But he seems like a relatively optimistic guy. Maybe that's just his nature. I don't know.
But, Stephanie, you said the last time you were on this program that if you were the Fed chief, you would do nothing this year.
Yeah.
Given the state of the economy, do you think that the Federal Reserve, because we talk about the concerns about inflation and the Federal Reserve overreacting and raising interest rates 4 times, again, continuing down this road of reducing its balance sheet by more than $400 billion this year. But do you think that they at some point have to reverse course and it's not 3 or 4 interest rate hikes, it's 2, and they change course on those balance sheet reductions if the economy slows and if inflation doesn't tick up?
I mean, how far into the bear cave do you want me to drag us? Because
drag us. We want to hear what you think. Drag us.
Where do you live? Where are you living?
Where do you live? Good way to put it.
But absolutely. I mean, I think that, to be honest, we talked about the potential for a 30% correction from here in stocks to bring market valuations back to, let's say, 10-year average PE norms. So that's a pretty substantial hit.
Is that dependent, like the Goldman thing? I'm sorry, Maria, but go to rates like going to 4.5%? Do you need to see something like that, or it's
that was ridiculous. Who said anything? I agree with you. 4.25%. Goldman comes out with this report that stocks will sell off if the 10-year goes to 4.25%. No kidding.
Which no one sees.
No kidding.
Right.
But you don't think we need that?
It's just FYI, at 3.03 on the 10-year yield, we saw the energy bust. That was sufficient. That backup in rates on the taper tantrum, I pin as responsible for bursting the energy bubble that we had because it was totally dependent on free money financing all these, new producers who otherwise wouldn't have been able to be viable. But so, back to Tegan's point, I mean, I definitely think there's a risk. The biggest threat to the economy right now is the stock market. And if the stock market corrects back to normal valuations, which one would think in the 9th year of this bull market might very well happen. We'd be lucky to go back to normal and not, revert below that. Then Powell's got a situation on his hand. We have pensions that are $3.8 trillion underfunded now after this massive boom in financial assets. I mean, it's stunning. We have silently bankrupted a generation of retirees and all these pensions. What's going on with GE is not an exception. No. That is the rule.
And we need to explain why GE matters, because this is an important point that you bring up. But wait a second. A minute ago, you said it's not out of the realm to see a 30% correction in stocks. Would that be over a couple of days? Would that be the year? What's your timeline on this, Stephanie?
I'm told never forecast direction and time. So let's just say I mean, I think hopefully it wouldn't be over a couple. Well, actually, it might be better if it were a couple days and then we could move on. But the pain is still going to be.
But this year, you're expecting that kind of pain this year?
I mean, I don't know if we get 30% this year, but I expect the markets to close lower meaningfully in 2018.
Well, that's the timing
and
issue.
that wipes away, and you've pointed this out before, because of the wealth effect. If you get a protracted, sustained decline in stocks, it wipes away the impact of the tax reform.
Just 10%.
Just 10%. I mean, I think Goldman takes it a little bit further, but again, that tax reform in the short run is worthless if you get a decline in the stock market. And again, as the Fed is tightening monetary policy, that's what happens is the air comes out of all of these asset bubbles.
This is the thing. Let's keep it simple, right? I mean, if QE inflated financial assets and lowered rates, QT should necessarily take that money out. I mean, it's not like you can have both the economy accelerate and asset prices go up when you're taking the credit underneath both of them away.
And just think if all of these things are just a question of if not when, or an order of magnitude and timing, there are political ramifications to that. Midterm election year this year. But as other people who disagree with your timing thesis on this would say, you could make the argument that all of this is put off, that the economy looks good this year and next, and then it's put off until a re-election year potentially for the president in 2020. So that's why the timing matters.
The timing is huge. And I guess the early indicators are a little concerning. You know, I've been watching the February data like a hawk because that's when the tax impact really hit people's paychecks.
Right.
And the weekly retail sales numbers have just shown no increasing, no acceleration since January. So it's running really the same pace, which is surprising because January, as you'll recall, was disappointing for retail sales on top of December. So, you know, it's really not looking super good. Mortgage applications.
Which is typical, though. January is usually not great after a lot of spending happens in December. But now this new conversation about trade seems to be just accelerating this worry because the Trump administration is asking steel and aluminum executives to the White House today, telling them an announcement could be made on steel and aluminum imports. That's according to the Journal. Here's what Commerce Secretary Wilbur Ross told me back in January. Listen to this.
We have proposed to the president a variety of kinds of actions that he could take in either case. Then he will select from among them or choose something different. We cannot allow our companies to be destroyed by unfair competition. If it's a level playing field and they can make a better product and a cheaper product, fine, then they should win. They shouldn't win just because they're subsidized in dumping.
What do you think?
Well, I don't think protectionism is ever bullish for the economy or for the markets. So that has me really nervous.
Dagan, you worried about what the president may do here?
I think that if you start to see mounting concerns, I was worried when they slapped those tariffs on
washing machines,
solar panels, and the washing machines, because it was a microcosm of a broad attitude that you got. Listen, it shouldn't come as any surprise. He talked about this at length on the campaign trail. Nevertheless, at a time, if the markets are really concerned about inflation and job creation, you're going to make it more expensive for a Samsung to build washing machines here in the United States, because it wasn't just a tariff on the washing machines, it was a tariff on above a certain level on the parts used to assemble them. Those are American jobs, and that goes and again, costs are going up.